Good morning, everyone, and welcome to today's IDOT workshop on insurance bonding and risk management. Today's presentation is presented by Kevin Scanlon. He's Vice President of Hub International Limited. So just to go over a few housekeeping rules, please mute yourself and keep video off. Enter all questions in the Q&A. Please don't enter them in the chat. And we will answer questions throughout the presentation. This session will be recorded and provided to firms in a follow-up email along with additional helpful resources. There may be a short survey following the presentation. Please let us know how we can improve ideas for future workshops. So today's agenda includes the introduction, housekeeping. We're going to go over IDOT's goals, supportive services and resources, basics of bonding, insurance basics. We'll go over Q&A and then our closing remarks. So IDOT's goals. IDOT's goal is to provide assistance to DBE firms and individuals interested in doing business with the department in ways that ensure equity, access, and transparency. IDOT, in accordance with federal guidelines, strives to facilitate and implement programs that can help current and future business partners open the door to doing business with IDOT. The department works towards this goal in a variety of ways, most notably through the tools available at our resource center. The supportive services program that is executed through our partnerships with consultants who provide management and technical supportive services assistance, and corresponding supportive service programs that fall under the umbrella of supportive service program. This support is provided at no charge to IDOT's DBE firms, to firms seeking IDOT DBE certification, to Illinois UCP DBE certified firms who have an IDOT contract, and to prime contractors doing business with IDOT. So the contact at IDOT Office of Business and Workforce Diversity is Brian Hendricks. He is the Policy and Supportive Service Unit Manager. His email is on this slide, and you can contact him with any questions. Learn and grow with supportive services. While opportunities may increase for certified DBEs, it is not guaranteed. Free programs and resources support firms' goals at all phases of growth. So develop technical and management skills, navigate operational expenses, connect with established firms, discover best practices for successful work with IDOT. So you can visit idot.illinois.gov to find your nearest resource center. So with the resource centers, each of the IDOT's 9 districts offer essential equipment and resources to conduct business with the agency. These resource centers include computer access, internet, scanner copier printers, staff assistance, including support for DBE applicants. These resource centers are free of charge to all firms seeking to do business with IDOT. Again, visit idot.illinois.gov for a list of locations. And here we have a list of the locations in District 1. There is one in Chicago, Park Forest for District 1. District 2, there is a resource center in Dixon, Illinois. District 3 in Ottawa, Illinois. District 4 in Peoria. District 5, Paris, Illinois. District 6, Springfield, Illinois. District 7, Effingham, Illinois. District 8, East St. Louis, Illinois. And District 9 in Carbondale. So those are all your resource centers. So here we have the contract compliance officers for each district. District 1 is vacant. District 2, Kayla Wiggins. District 3, Tammy Mescal. District 4, Sally Turzen. District 5, Stacy Lawton. District 6, Michael Fish. District 7, John Shroom. District 8, Jamie Franklin. Bilal Hamid. In District 9, Deborah Lee. So with IDOT, they have the technical and management assistance. So ongoing assistance helps DBEs maintain a competitive edge through estimating and bidding, financing, accounting system, business plans, and much more. These are services that are provided to IDOT's DBE firms at no charge. And they are also provided to firms certified in the Illinois UCP that are bidding on IDOT contracts. So this is a list of supportive services consultants. For certification in District 1 through 3, we have Theo Joyner with Ralph G. Moore and Associates. District 4 through 6, Melissa Hamilton with Synergetic Solutions. And District 7 through 9, Mark Vaughn with FV Consulting. And their phone number and email address is on this slide. For management services, District 1 through 3, we have Michelle Ringgold with Ringgold Financial, which is our firm. Our phone number is here, and Michelle's contact email is there. District 4 through 6, we have Melissa Hamilton with Synergetic Solutions. District 7 through 9, Mark Vaughn. And for the technical services, for District 1 through 9, we have David Clark from ESI Consultant. So you can go ahead and see there is the number and his email for more information on the technical side. IDOT conducts workshops and events. The Bureau of Small Business Enterprises brings innovative events to the public with three goals in mind. Share skills to become more competitive on IDOT projects, help individuals and businesses work with IDOT and form strategic partnerships, encourage sharing of best practices, policy, and procedure changes. Each district hosts events year-round to help firms to do their best work with IDOT. And in the bottom, you'll see a link, bit.ly DBE workshops, and you can access the workshops there. So today's challenge, tomorrow's reward is IDOT's annual conference that provides opportunities for networking, skill building, and knowledge sharing among our vendor network. All firms doing business with the department, including primes and subcontractors, consultants, suppliers, and our various partners are welcome. And this year, this fiscal year, the TCTR will be February 15th and 16th in Springfield. If you have any questions, the number is here, 217-782-5490. And now the available programs by IDOT. So IDOT has a DBE reimbursement program, which offers 50% reimbursement to qualifying firms in select categories while funds are available. So you can get up to 50% reimbursement and on association organization membership cost, training or certification class, website capability, statement and logo. So you can contact the Bureau of Small Business Enterprises to discuss criteria for these limited time funds. The Business Development Program, qualifying DBEs can receive firm-specific guidance to propel their growth in the transportation industry. And what they receive is full business evaluation and analysis, tailored training that may be eligible for reimbursement, personalized recommendations to maintain competitiveness, and how to apply. Enrollment opens once per year. 15 firms are accepted annually, and the applications for 2023 will be opening soon. So you can visit idot.illinois.gov for more details. Mobilization payments. To account for the preparatory work and operations necessary for the movement of subcontractor personnel, equipment, supplies, and incidentals to the project site, and for all other work or operations that must be performed or costs incurred when beginning work. The contract shall make a mobilization payment to each subcontractor. The mobilization payment must be made at least 7 days prior to the subcontractor starting work. The mobilization payment to the subcontractor is an advance payment of the reported amount of the subcontract and is not a payment in addition to the amount of the subcontract. Therefore, the amount of the advance payment will be deducted from future progress payments. The amount paid is a percentage of the value of the subcontract shown in the table below. For more information, you can reach out to IDOT for the mobilization payments, but here is a table that you can look at. As a reminder, we'll be sending out a copy of this presentation in PDF format. And we have, and IDOT has the HCCTP program, the Highway Construction Careers Training Program, boosts participation of diverse individuals in the industry and on IDOT's highway construction projects. Illinois Community College partners offer training in industry, trade, and life skills. So some of the training they receive is OSHA 10 certification, welding, forklift operation, first aid, CPR, AED, math for the trades, introduction to electrical, plumbing, sheet metal, carpentry, introduction to tools, and more. Employment is not guaranteed. However, participants do receive job placement assistance. 4 reasons on why HCCTP graduates make ideal hires. Well-trained to fill entry-level roles, professional talent with diverse perspectives, eligible for work on IDOT project sites, reimbursement via IDOT training special provision TPG. So who can apply for the HCCTP program? Eligibility is open to women, minority groups, and other persons from historically underutilized population. You must be 18 years old, must have a high school diploma or GED, a valid driver's license, and ability to pass a drug screening. So we're going to go ahead and get started. So just a quick reminder, please remember to enter your questions in the Q&A box and maintain muted and with your camera off. So we're going to go ahead and have Mr. Kevin Scallon from Hub International go ahead and get started.
Well, good morning, everybody. Thanks for attending this webinar on bonding and insurance. We'll start with the bonding portion first and then finish with the insurance part. So bonding, also known as suretyship, is a partnership between 3 different parties. You know, the first party is to the suretyship relationship is the principal, which is basically the contractor. So the second party would be the obligee. They're the beneficiary of the bond. That is typically who the bond would go to or towards, which is typically the owner of the project, and they obtain the benefit of the bond. And then, of course, the third party within the relationship is the surety itself. They're the party who guarantees the bonding to the owner. So those are the 3 different parties to a surety relationship. So the principal, as mentioned, would be typically the contractor in this case. There's certain obligations required by that of the principal, and that is to, 1, protect your surety or its surety against a loss. That's what you really don't want to have is have the surety step in and have a claim or a loss on the bond. The next obligation for the contractor or principal would be to perform the obligations faithfully. And those obligations are really the contract that you would have with the owner, that you are required to fulfill that contract, complete that contract, and do so without a loss. And the final third thing is to provide, regular updates or, reports, whether it be financial reports or progress of the particular, bonded projects, and give periodic updates as to the performance of those projects. The obligee has certain obligations as well, or the owner. They want to make sure that they have to make sure that there's a meeting of minds between both the principal or contractor and the owner. the obligee or owner also is required to fulfill their contractual obligations under the contract, which would include, say, paying the contractor for progress billings, and fulfilling their financial obligation under the contract. And then there are occasionally some, contacts between the surety who wrote the bond to the owner, requesting certain updates as to the progress of the contract or project, and the obligee owes an obligation to that surety to provide that data. Finally, you have the surety. They have obligations under the bond, and those obligations would be only when there's a potential for loss or claim under the bond. And if there is a legitimate, surety claim made by the owner to the surety has an obligation to make payment to the obligee if there is a financial loss on the project. They also, the surety company has some defenses under the surety bond to resist payment if the obligee or owner has not fulfilled their obligations under the bond. So there's all types of different bonds. We're emphasizing here the category of contract bonds. And there are typically 3 bonds provided in this area. The first one is the bid bond. A bid bond is required when you are bidding a project and the owner or obligee in this case requires a bid bond. And that bid bond obligates both the contractor and the surety that if the contractor is the low and responsible bidder, and there will be a contract issued, that bid bond obligates the surety company to provide both a performance and payment bond once that contract is issued. These bid bonds are usually expressed as a percentage of your bid amount. You typically either 5% or 10%. So that's a bid bond. Upon awarding of a contract, the obligee will require both a performance and payment bond from the contractor. The performance bond, basically guarantees or indemnifies the owner or obligee against any loss resulting from the failure of the contractor to complete the work. So if the contractor is unable to fulfill that obligation of the contract, the surety company under the performance bond is required to go in and complete the project. The payment bond, which are always issued in conjunction with the performance bond, guarantees payment that all subcontractors of the principal or contractor in this case, or any suppliers, or any labor and material for the project are paid. And if the contractor doesn't fulfill that obligation, the surety company is required to step in and provide, payment for all that. Okay. So when a bonding company looks at a contractor to provide surety credit to them, they look at basically in 3 broad categories for suretyship. The first one is character. The character of the owner of the company, the construction company. To look at the capacity of the construction company, which would include, experience of the contractor, and finally, capital. the financial component of the contractor that they're looking at. So those are the three broad categories they look at. In terms of the first one, character, how does a surety judge the character, of the contractor, right? They want to look at certain, elements of the owner or owners of the company and see what, current and past history they have of them. And they'll look at obtaining resumes of the owner to see what their prior experience was, both in employment and schooling. They'll basically look at the personal credit of the owners of the construction company. Typically, poor credit obviously is a bad reflection on the part of the owner of the company. They'll look to see within the credit structure if there's any been past prior bankruptcies. They'll look at age, although they won't discriminate based upon age, but certainly, age of the owner reflects, their risk characteristics and stuff. So those are the components of the character piece they look at. And, what else? And one other thing that's not mentioned on here is, the surety typically meets with the owner or owners of the construction company to meet them and do an interview, so to speak, on their character. The capacity piece is, again, looking at what skill set does the contractor have, both personally or through their existing construction business. And they'll look at your past prior projects that had been completed. They'll look at what corporate, credit you may have. They'll look at what kind of financial credit you may have, or including, bank lines of credit or other sources of credit. They'll look at the management piece of the business to see what kind of organizational structure do you have, both in terms of your office capabilities and field capabilities, and what kind of cost control measures do you have of the business. They'll look to see what equipment you would have necessary to complete what projects you are seeking. They'll look at continuity planning. What would happen if the owner were to unfortunately have to stop operating their business for various reasons? Who other in the company does the company have that could take over the control and management of the company? And they'll look at your area of operations. They'll look to see if you're doing just local work, or if they're looking, or they're one of the things they'll look at to see if a contractor is doing work beyond their local area of operations. Usually that's a higher risk factor when contractors are working out of their normal area of work. Finally is capital. Capital is basically cash, your financial ability, financial statements. So they'll look at, what kind of cash or liquidity does both the company have, the construction company, and personally as well. Usually there's financial statements provided by the contractor to the surety, and surety companies will go through some financial analysis and determine what kind of credit structure you have, which would lend to, surety credit. And then they'll look at prior projects and current projects and look to see how those are financially performing and trending. Those are the three areas that they'll look at for capital. So I kind of touched on some of these before, but when a surety company is presented with your um, looking for possibly surety credit for your particular construction company, these are the things that they would typically require from you. And looking at basically the profile of the company, they'll want resumes on the owners, or if there's a key employee of the company who may have vast experience in the area of operation that you're doing. Look to see again what kind of business plan do you have. What are your ideas and on where you want to go for the near future of the business. I talked previously about the continuity plan. Surety feels that understanding your continuity plan is important, especially if they're looking to provide you with a lot of surety credit. They want to make sure that before they step out there with a bunch of surety credit, that the business has some kind of continuity arrangement. And if finally they'll make sure to see you have insurance on your business. We talked about this a little bit. They're going to look at, they're going to verify what kind of capital you have. They'll look to see, what kind of cash you have in the business. They'll ask to verify that cash balance through a bank statement. They'll want to see what, if you have any lines of credit outstanding, a bank line of credit, other capital credit that you have out there, any other outstanding loans on the business. And then they'll want to obtain some financial statements. If you're new in business, they'll ask for a starting balance sheet of the company and to see what capital has been put in the company, if any. If it's established business, they'll ask for typically year-end CPA prepared financial statements. And they'll look to see about receivables, the quality of your receivables that you have outstanding. And then they'll ask for personal financial statements on the owner or owners of the company. The work on hand schedule is really just a schedule that's provided by the contractor that shows what current jobs the contractor has in progress. And anything that could be provided, which would provide benefit to the surety company, like letters of recommendation, certain awards that the contractor has received, or any other benefit, that could be provided to the surety. So, once a contractor is established with the surety company, and we'll talk about this in the near future, they set up a certain, line of credit, so to speak, in surety credit for the contractor. But when there's a specific project that a contractor wants to bid, which will require bonding, there are certain things that they're going to want to have submitted to them so they can underwrite that particular bid. And those three, items are below. They'll want to know the specific terms of the contract. And what is that? That is usually the completion, the length of the project. Obviously, they'll want to know what the estimated cost of that contract might be. They'll need to know the bid date of that project, a description of that project, whether or not there's any liquidated damages on that project, what the warranty terms of the project, and things of that nature. And they also may, at that particular time, maybe ask for some updated information on the contractor, whether it's, some financial performance metrics or status of, current bonded projects with the surety company. Okay, specific terms of the contract. I talked about some of these already, but they're in there as you could see them. They'll want to know what the project description. What is it? You know, what are they looking to bond? You know, what's the scope of work? Where is the job located? Is it geographically close to where the contractor is located? The look for time of completion. The time of completion is important for the surety to look at. There's less risk in a shorter term project than a long-term project. They'll want to look to see if there's any liquidated damages clauses in the contract. Is there $1,000 a day liquidated damage clause, or is it 10,000? Certainly something with a higher liquidated damage clause in the contract will cause more risk to the surety. What kind of maintenance guarantees are in the project? Typically, there's a 1-year maintenance guarantee in all projects, but there could be extended guarantees or warranties that have to be provided to by the contractor to the owner beyond 1 year. Certainly, anything beyond 1 year could create greater exposure or risk to the surety. Payment terms. What kind of payment terms will the owner be providing to the contractor on this project? And sometimes there could be specific bid bond forms or performance and payment bond forms that have to be provided to the owner for the project or the bid. And the surety will like to review those to see if there's any risk elevation in the type of bond form that's been used. Okay, so once all that information is submitted to the surety about a particular project, they may want to know certain things in there about your experience on that. So if there is a project that has a large amount of subcontracted work, and what items of that work would be subcontracted? What are the qualifications of those subcontractors, or your relationship with those contractors, or your past prior experience with those subcontractors? Can the subcontractor be bondable back to you? And we'll talk about some of the things, risk mitigation on the part of the contractor. Are there any special equipment that you'll need? What is your past prior experience, the contractor's past prior experience with this particular owner or architect or engineer? What is the reputation of the owner, right? What is your experience with that owner on projects? And then finally, financing. Typically, public projects are all bonded, and there's public money set aside for that project, where the determining the financing of the project is not necessary. But there are some private projects where bonds are required, where the surety company is going to want to make sure that there's been financing set aside for this particular project. So at the particular bid bond request or project bonded request that is sent in, they'll also want to know what your work on hand is at that particular moment, because that will understand or make better for the surety to understand what kind of risk they have. So, at the particular bond request, if there's a, much higher amount of work on hand that the contractor has, it may, cause it to be a more elevated surety risk versus a lower work on hand. So they may ask for a current work on hand schedule. They also may ask for what your current financial condition is. Bonding isn't necessarily a daily, and certainly not a daily, but sometimes not even monthly condition. So the surety company may be a little bit outdated on some financial information and may need to be updated with some current financial information. So when a surety company is prepared to provide surety credit to the contractor, they in return ask of the contractor to provide some guarantee to the surety. And there is an indemnity agreement that is prepared and provided by the surety to the contractor, in which the contractor and the owners of the company and their spouses indemnify the bonding company if there is ever a loss or a claim under the project. It would be really no different than kind of like a personal guarantee given in a loan situation to a bank. So it's very simple, same principle basically. Okay, so as I mentioned, when a bonding company obtains all of the information, decides to pursue surety credit for you, they set up a line of credit for the contractor. And they express those in both a single job basis and an aggregate basis. And the single job basis would be, what is the maximum amount of a bond that the bonding company will provide you for up to one single project? So in the example is stated there, a surety company could give you a $750,000 single job and 1.5 million aggregate line. The aggregate is, they would provide, if you were successful in getting two $750,000 single bonded projects, you would hit your aggregate line, and your surety credit will be, you would have no more surety credit. The good thing though about this is that the surety company, at the time of a bid request, will look at how much of that bonded work has been exhausted. So in the example I just mentioned, if you had two $750,000 bonded projects, which equated to 1.5 million, but at the time of a future bid request for another surety bond, both those projects were worked down to about, let's say, $1 million left to complete, you would have about $500,000 in aggregate, bonding capacity available to you. So there's all sorts of ways to improve bonding capacity, and it's always a challenge of contractors to get as much surety credit as you can. I can't emphasize that some of the items here mentioned really improve your surety credit. So first, I would say is you hire a good surety agent. Surety is a real specialty area. It comes from the insurance industry, but it's a very small and area of expertise. And I can't emphasize by having a surety agent with a lot of experience in this field. When you do have that surety agent, it's really important to keep the surety agent informed of all your business activities, because they are the go-between between yourself and the surety company, and the surety agent is the one who is selling on your behalf, basically your business. CPA, extremely important to have a good CPA with a lot of construction experience. It's a specialized field as well in terms of accounting, and I'd recommend the best construction-oriented CPA for your firm. Select a good bank. That's obvious as well. Many banks out there are not friendly towards lending on the construction side of the business. So establishing a relationship with a bank who's construction friendly is important as well. The CPA with whom you would hire would assist with this, but maintaining quality accounting records. As mentioned, the bonding company may ask for periodic financial updates, and providing the surety company with really quality information, quality financial information, accounting information will be really important. There is a relationship between both the contractor and the bonding company. And it's important to really meet with your surety company once a year to go over the progress of your business, and for them to ask any questions they may have. So there's other ways to get bonding. Those are just like some items mentioned there. If for some reason, you're having difficulty getting, surety credit or expanded surety credit, there's other ways to, you could always, get third-party indemnity. That's when somebody who's provides, a really good, personal financial, and would indemnify on your behalf. It's like a third-party guarantee. You could sometimes you could provide surety with some collateral to mitigate the surety's risk. Sometimes you could get the subcontractor's years bonded back, which would reduce the surety's exposure. You could phase the project where you're only bonding instead of the whole 3 phases of the project, bond each phase or sequence it. And then there's another joint check you could do. All right, so what does it cost for these bonds? It really depends on a lot of factors. I tell you below, bond rates can be as low as 0.75% to 3%. And those ranges depend on a lot of factors, including the financial performance of the contractor, how much bonding they do, with the contractor, and what kind of the quality of the financial information provided to the surety. Yep. Okay, so reasons for contractor failure. There's many of them. It's tough business. Just from personal experience, I would say that the one that probably is number one is growing too fast, too quickly. That's why we have on there too successful, which leads to financial overextension in some areas. But those are the most common forms of contractor failure. I would say the second most is going beyond your normal operating territory. But there could be lots of reasons. Unfortunately, a larger sub on a project can go under, which could cause you quite a bit of financial harm. Lack of proper financial accounting on your end, could be, lack of experience on a particular project that you've taken on. So there's, really 3, almost 4 areas of surety, sources of surety. We've kind of talked about how you can go to there's a standard surety marketplace where you could, get set up for a single project, an aggregate project with a standard surety marketplace. But if you're new in business, or maybe things aren't financially well with you at the moment, the time you need financial bonding, there's these specialty surety markets that will, for a higher fee, be able to provide normal bonding, but will take some measures to protect themselves, including maybe getting a letter of credit from your bank as security, or funds control, we call it, or that'll help mitigate the surety's risk. The third area is the SBA program. Again, that is probably a higher fee area, but the SBA guarantees a certain percentage of the bond to the bonding company, which mitigates the surety's risk and makes it a little easier to get a bond. All right, so there's certain do's and don'ts for contractors. We touched on most of these already, but always select a good surety agent, CPA, and bank. Keep your agent well informed. Make sure you have good financial records. Certainly the don'ts are, speculating is not a good thing to do. uh, Wait last minute to request a bond from a surety. It's kind of a lengthier process than you think. Or furnish poor quality financial information to the surety. Those would be certainly don'ts.
At this time, if you have any questions, if you can either unmute yourself or put it in the Q&A. We'll give you a minute or so. Okay, we're going to go ahead and get started with the second part, insurance bonding and risk management. Again, just a reminder, if you have any questions, please put it in the Q&A and we will answer them as we go. Thank you. Back to Kevin.
Okay, next section we'll talk about insurance for your business. So insurance could be kind of broken down for a business into two areas. Mostly the insurance that you purchase for your business will be for the benefit of the direct benefit of a third party. Your commercial general liability coverage that you'll be purchasing, your commercial auto liability coverage, workers' compensation, umbrella, or also known as excess casualty insurance. And the second part is first party coverage. That would be the coverage that would benefit the contractor directly. So commercial auto physical damage, what I mean by that is, if you got in an commercial auto accident and there was, property damage or physical damage to your vehicle, that's where you're the first party of coverage. Commercial property, any property that the contractor owns that you're insuring, you would be the, beneficiary of that coverage. And inland marine is really coverage for any equipment or tools or material that you would want to insure. So we'll talk first about commercial general liability coverage, and insurance coverage that you will need to purchase for your business. It'll be required of you for any project that you obtain. And the commercial general liability policy provides coverage to really third parties for any property damage that may occur on your construction projects or any bodily injury that may result from your construction projects. Those limits of insurance are expressed in $1 million levels. So typically on a commercial general liability policy, we have $1 million each occurrence limit and a $2 million general aggregate limit. And what that means is that, the business, the construction company, has $1 million of coverage for any one accident or occurrence that may result, and has $2 million of coverage in its entirety. So it would cover two separate incidences or claims or either property damage or bodily injury claims up to $1 million. So if a third claim happened, there would be no coverage because it would exceed, the general aggregate limit. So there's just like on a homeowner's policy or a personal auto policy, there are deductibles on the general liability policy that would apply to any claim arising out of whether it was property damage or bodily injury. The general liability policy also provides, defense to the contractor if a suit were to arise, and any claim-related expenses that would result from that. So who is covered under the general liability policy? First off, the named insured. The named insured is the contractor, whoever's the, policyholder. It also include, if you're a partnership, the partners, if it would include any officers of the company, directors, stockholders. It would cover any of the employees of the business or volunteers, or anyone added by endorsement to the general liability policy. Who is not covered are joint ventures. So if there's a joint venture formed, the joint venture is not covered under your general liability policy unless added onto the policy at a later time. So every insurance policy has certain exclusions in there. And the reason they have the policy exclusions is the intent is that they're going to be covered somewhere else. So for example, it excludes any type of workers' compensation claims because that has a separate policy. It excludes pollution-related claims because that is intended to be covered under separate pollution policy. Auto policy excludes claims related to auto because the auto policy is intended to cover that. Your faulty workmanship is not covered under a general liability policy. The intent of that is to be covered under performance bond if provided. So, how are these priced? General liability, it depends on a lot of factors. It depends on what state you're operating out of. And it could be specifically what county you are and what city you're located. There's a lot of territorial rating in this. What classification of work you do. Certainly, some construction classifications have higher exposure than others. For example, roofing would be a higher rated exposure than, say, landscaping. What deductible you have on the policy, a higher deductible, the rates would be lower versus a lower deductible. And then there's finally like the insurance market conditions. We call them hard and soft markets. Sometimes there's insurance markets where there's just firming of pricing or hardening of the market. And sometimes there's in the insurance marketplace, rates are softening. So it depends on those factors as well. Commercial auto, mentioned this, you have liability coverage. Like the general liability policy, commercial auto liability policies are written in $1 million limits, and those limits are typically $1 million. Provides liability coverage to others by you. Similar in terms of who is covered, the named insured. We talked about those named insureds earlier. It would be any permissive users like employees. And then like the general liability policy, there's exclusions in auto policy. Certainly the auto policy is not going to pick up any workers' compensation exposure, as that's intended to be covered under a separate policy. Any mobile equipment that would be covered under an inland marine policy, and pollution related hazards, as that's supposed to be covered under a separate pollution policy. We talked about the physical damage coverage to the autos. This is really no different than your personal auto policy that you would have, where you have comprehensive coverage and collision coverage. And the commercial auto policy pays for, is paid the value of the vehicle at its time of loss, also known as its actual cash value. There's certain factors that affect the pricing of the auto. policy, where is the vehicle garaged? Is it garaged in Chicago, which has a higher rating factor than, say, Central Illinois, let's just say? The weight of the vehicle, is it just a pickup, or is it a tractor? Tractors are heavier vehicles. They're going to cost more than a pickup. Radius of operation plays a role. If it's all local driving, it's going to be cheaper than that with long haul driving. The driving records of the drivers, what kind of credits you have on there, on the policy, and how many vehicles you have on there. Sometimes when you have 5 or more vehicles, they provide a fleet credit on the policy versus having just 1 or 2 vehicles on there. Workers' compensation. So this pays for any medical or disability benefits to an injured employee. And who is covered? Well, it's certainly the named insured and any of its employees of the business. So there are certain exclusions on a workers' compensation. It would be an intentional injury would be excluded. I know it's something here called employment practices liability. That's covers the business against wrongful termination lawsuits. And certain federal work comp acts are also excluded under a work comp policy. Similar to the other lines of coverage, we have how are rates determined on your work comp. Depends on what state you're operating. Each state has its separate rates. What kind of work do you do? Where would the employees be classified? Every construction classification has its own code or classification and rates. For example, roofing would have a certain rate versus plumbing or electrical. Whether or not you have an experience modification factor, we'll talk about that in a second, will affect your rates. And whether or not there's a deductible on the policy as well. So experience modification factor, or EMR, this is probably the most important thing in controlling your work comp costs. It is something you establish after having been in business for 3 years. And when they look, when your experience mod is calculated, they look at the last 3 years of workers' compensation experience or claims. And, those contractors who have low claims experience or low workers' compensation losses are going to have develop an experience mod that is less than 1. Those that have poor workers' comp experience, losses or claims are going to develop an experience mod greater than 1. And I will tell you that having a mod less than 1 is, 1 is the average, but having a mod less than 1 is really important as opposed to having a mod greater than 1. So umbrella coverage. So we talked about how the general liability policy only has $1 million of coverage per occurrence or per accident. The auto liability policy has a limit of $1 million per occurrence or per accident. There's an umbrella policy you could purchase that would provide an additional layer of coverage over your general liability limits of $1 million and your auto liability limits of $1 million. So if you were to buy $1 million umbrella, you would now have 2 million limits of each occurrence limits on your general liability and 2 million on your auto. Commercial property. So this would cover any buildings that the contractor owns or any improvements and betterments you've made to that building. any contents within that building or business personal property. Could cover also business income or extra expense coverage, that business income would play a role if there were a property claim and you were no longer able to operate your business and had a loss of business income, it would cover that. So what is not covered typically on a property policy? Any type of flood exposures, earthquake, and volcanic activity. I don't think we have to worry about that. Okay, I think this is the last coverage. So inland marine. So this covers any type of equipment that you may own, or any type of tools that you have, or any type of material that you need or procure for your projects. And that's really about it, I guess. It's easiest. Okay, your premiums, I don't.
So we're going to open up for any questions. That concludes Kevin's presentation. So if you have a question on any of these topics, if you want to put it on in the Q&A or unmute yourself so we can answer questions. Okay. Looks like there's no question. So we're going to go over some of the available resources with IDOT. So we have some upcoming, yes?
Yeah, I'm sorry. I put a couple questions in the Q&A.
It's in the queue. Hold on. Okay, for some reason it's, let me.
I can just ask them right now.
Okay, yeah, that works. Thank you. I'm sorry about that.
Yeah,
It's
no
not-
problem. Quickly, like on auto coverage, if you have a trailer with your equipment in it, is that picked up by the auto, or do you need a separate policy?
So the trailer would be covered under the auto policy, you know, if it's scheduled on the commercial policy. Any equipment that is contained on the trailer would be covered under the inland marine policy if that equipment is scheduled on the inland marine policy.
All right. When you are 100% using 100% subcontracted labor, like the only place we can get covered is through the fund. But if you're doing work in like different states, and once again it's 100% subcontracted labor, do we just have to keep getting fund quotes in each of those additional states, or is there a way to get work comp coverage when you have no employees?
So I'm assuming you're referring to workers' compensation coverage, is that right?
Yeah.
Okay, no problem. So yeah, so for a general contractor or a paper general contractor in which they don't perform or self-perform any of the work and sub it out, typically that is difficult exposure for insurance companies, and typically do not like the right to work comp coverage on a paper general. And so I'm assuming when you say the fund, you're talking about the workers' compensation fund in each state. Correct?
Like right now we have one policy in Indiana, one policy in Michigan, and then we were trying to see if we could get a policy, because like we're picking up projects in different states.
Yeah.
And it's like, and then every time it's like, and the thing is we have no employees, so it's always,
Right.
pain.
It is. So yeah, work comp is, state statutory. Unfortunately, there isn't like a comprehensive policy you could provide or, purchase. for all states, unless you frankly find an insurance company that's willing that, outside of the workers' compensation fund, the assigned risk plan is what we're referring to, uh, purchase something like that. So you do is the short answer.
All right, and then the last question is, and this is kind of like tied in with quality of work, and that I understand the bonding pretty much based on your presentation, but like if you go in and do a job for a client and they stiff you on on your pay,
Yeah.
is there any type of insurance that covers you for that,
No.
or
Well,
do you just have
let
to
me ask
hire a?
you, is this through an owner or through a general contractor?
So, well, I guess right now we're dealing with the own like homeowners associations,
Mm,
and so like,
no, there isn't, unfortunately.
all right, but if we're a sub and we're dealing with a GC, is there something there?
There is something there if the GC provided a bond to the owner. So if the GC provided a performance and payment bond to the owner, that payment bond provides you, the sub, financial protection if the general does not pay you. And you could make a claim against the general's payment bond with their surety company. But if the general did not provide a bond to the owner, then you're only, is legally, you're only,
Right, you have to hire a lawyer and have them collect
yeah,
it.
yeah, you do. So that's why, a lot of subs, if it's a public project, they are required the general would be required to provide a bond to the owner. Um, so,
Well, and I don't know if Michelle maybe can answer this question. I know Illinois, what is it, CBIF? They have like a requirement as far as like GCs have to pay the subs within like a week and a half, or all their payments get stalled up. Is the tollway the same way?
So Michelle's not on the meeting. You'd have to ask, probably reach out to IDOT or, or the tollway.
Oh, I got you. All right. Yeah, I was just wondering because I was at a CBIF meeting recently, and I guess they have something where like if you're a sub and the prime doesn't or the GC doesn't, pay you within the agreed upon time, which is I think it's like 10 or 15 days, then the state will stall all their payments. I was just wondering if it's like because they're separate entities. I don't know if they
Yeah,
it's
you'd have
similar.
to ask the entity that you're working with.
All right, cool. All right, yeah, thank you. The bonding section was very was incredibly helpful because that whole area is just like very, none of us know what's going on, so
sure, no problem.
that was great. Thank you.
You're welcome. You can reach out to me anytime if you have any further questions, okay?
Yeah, I don't see your contact on here. I know it was in the beginning, but I didn't write it down. Is there somewhere I can find it on here?
So I put my email in the chat. You can go ahead and reach out directly to me
All
and I
right.
can send you Kevin's info for sure.
All right, cool. Thank you.
Okay, you're welcome. Does anyone else have any questions? If you'd like to unmute yourself right now, that way we can get them answered. We're going to go ahead and finish up the presentation. Just a reminder while I'm finishing up, if you can please enter in your name, the company that you work for, that you are representing today, so we can get participation points in the chat. That would be very helpful. And again, we'll be sending out the copy of the presentation in a later email. So just some upcoming events to look for are Prime meet and greets in January of 2023. There'll be one for District 4 and District 1. We don't have a date yet, but keep an eye out for that on the bit.ly workshop link. So you can go ahead and subscribe to our Eventbrite page to get updated news and events scheduled. So we can go ahead and send that link out also. If you need it, just go ahead and reach out to me. So here are some of the, so the Building Blocks of Success workshop series will continue through March 2023. You can register via Eventbrite. Again, the link is there. The December 7th, well, that was yesterday. There was a Prime DBE meet and greet. So the upcoming workshops that we have for December is how to develop a strategic plan on Tuesday, the 13th, and how to develop a business plan on December 15th. So we do encourage for you all to sign up and attend these workshops. So the Illinois Department of Transportation also has a YouTube channel. The YouTube link is there below. You can view different videos from the Illinois Department of Transportation. So here's a list of a couple of videos that they have out. And there, again, there's more the webinars. So here, this is where you can find the past workshops and webinars that that IDOT has conducted. So here you go. The link is here. Again, we'll send that out, this presentation out, and you can also find it on the IDOT page. So we'd like to thank you for attending today's workshop. And then if there is a link for a survey, we do encourage you to complete that and give us your feedback. And then as a reminder, we will go ahead and send a follow-up email with the recording of the event, the presentation, and any links to resources and programs, upcoming workshops and events, and then the contact information for OBWD staff, consultants, and contract compliance officers. So again, we'd like to thank you. Okay, and here is the contact for the supportive services in Borough of Small Business Enterprises. So please feel free to email or call. And again, we'd like to thank you for attending today's workshop.